So have you ever tried sending, say, 20 bucks worth of Ethereum, only to hit the confirm button and realize the transaction fee is almost as expensive as the money you're actually trying to send? It is incredibly frustrating, right? I mean, you get that universal moment of panic, you're staring at the screen, sweating a little bit, wondering if you should just cancel the whole thing. And then you might see someone else transfer their crypto on a completely different network and pay literal pennies for what looks like the exact same transaction. It feels super inconsistent and, frankly, a little mysterious, which perfectly sets up the core mystery of today's explainer. And that brings us to the giant elephant in the room. Why aren't crypto transactions just free? I mean, think about it. The whole pitch of cryptocurrency, the very reason it was created in the first place, was to remove banks and greedy middlemen. It was supposed to be completely decentralized and frictionless. So, if there is no central bank taking a cut, why on earth are we still paying to move our own money around?
Okay, let's dive right into this. Here's our roadmap for today. We are going to look at the gas fee mystery, who gets paid, changing prices, we run a $100 test, and finally, smart ways to pay less. Understanding these mechanics will literally save you money every single time you use a blockchain.
Section 1. The gas fee mystery. What exactly is a gas fee?
Well, a gas fee is simply the cost of performing an action on a blockchain, and it serves two absolutely crucial purposes: rewarding network security and preventing spam. Let's use a quick analogy to make this super clear. Think of a blockchain like a massive digital highway, okay? Your transaction, whether it's a transfer, a token swap, buying something, that's a car trying to get down that highway. Well, gas is literally the fuel that allows your car to travel. Every time you send Ethereum or use a decentralized app, you're asking thousands of independent computers around the world to act as the engine, verifying and processing your specific request. And you know that immense computing power just isn't free. Plus, without these required fees acting as a barrier, bad actors could easily flood the network with millions of automated spam transactions, which would bring the whole highway to a grinding halt.
So, Section 2. Who gets paid? Where does your money actually go?
Now, there's this really common misconception, especially for beginners, that Ethereum is some sort of centralized company, and there's a CEO sitting in a corner office collecting all these fees as profit. But Ethereum isn't a company. The fees actually split two ways. A portion goes directly to validators. These are the individuals and computing pools providing the actual hardware and power to process transactions and secure the blockchain. It's a direct reward for their hard work. But the other portion? Actually, this is where it gets interesting. It simply disappears. Thanks to a network upgrade called EIP 1559, that part of your fee is permanently burned. It is literally removed from the total supply of Ethereum in circulation forever.
Section 3. Changing prices. Or what I like to call the rush hour effect. Let's tackle the confusing volatility here. Why can the exact same transaction cost 20 cents today and $10 tomorrow?
The answer really comes down to just three words: supply and demand. The crucial thing to understand is that a blockchain has a strictly limited amount of space in each block of data it processes. When millions of users are trying to send transactions at the exact same time, they all have to compete for that limited space. It is exactly like thousands of cars trying to merge onto a highway during rush hour traffic. It gets miserable. If you want your transaction processed faster than the next person, well, you have to be willing to pay a higher fee to skip the line. Let's look at a very specific real-world scenario that causes this: the NFT launch effect. Imagine a highly anticipated NFT collection goes live. Suddenly, hundreds of thousands of people are mashing the buy button within minutes of each other. The network gets insanely crowded, and a crowded network equals spiking fees. Everyone basically enters a frantic bidding war for the next available block, sending gas fees straight through the roof as users fight to get their transaction verified first. If you've been around crypto for a bit, you've definitely felt that pain of trying to mint a simple digital collectible, only to realize the network fee is suddenly hitting 50 bucks.
Moving on to Section 4, the $100 test. We're going to shift from theory to reality here and look at how different networks have completely different costs.
Let's say we send exactly $100 across 3 different networks, just to see what happens. On Ethereum, sending that $100 might cost you around 20 cents during normal, quiet conditions, but that can easily jump to several dollars when it's busy. And that's because Ethereum heavily prioritizes decentralization and maximum security above basically everything else. Bitcoin handles things a bit differently. It usually sits around 20 to 30 cents, calculating fees based on the actual transaction data size rather than complex smart contract execution. And then you have Tron, which is heavily optimized for efficiently moving stablecoins. Sending $100 there is usually going to cost you a very predictable 35 to 60 cents, depending on network resources.
And this brilliantly illustrates what happens when a network is built specifically for low costs and high speed. 7 cents. Seriously, that is all it typically costs to send that exact same $100 on the BNB Smart Chain. Because it's focused so heavily on faster, lower-cost transactions, almost your entire $100 reaches the receiver perfectly intact.
So here is the absolute core takeaway of this explainer if you remember nothing else. The amount you send never changes the fee. The blockchain you choose does. Whether you're sending $1 single or $1 million, it requires the exact same amount of computing work from the network. It's the highway you choose to drive on, whether that's Ethereum, Bitcoin, BNB, or Tron, that dictates your final cost, not the amount of cargo you have in your trunk.
Section 5, Smart Ways to Pay Less. Let's break down a little bit of the technical jargon so you can actually start keeping more of your money.
Before we get to the actionable tips, we just need to quickly decode two confusing terms you've probably seen pop up in your crypto wallet: gas limit and gas price. It's easiest to think of it like ordering a taxi. The gas limit is simply an estimate of how much work or fuel the transaction needs. A standard ETH transfer needs very little work. But a complex DeFi smart contract swap, that requires a lot of computation. Then you have gas price, which is how much you are willing to pay for each unit of that specific work. Think of gas price as offering a higher tip to your taxi driver for faster service. You multiply those two numbers together, the limit and the price, and boom, that equals your total transaction fee.
So let's look at some practical applications and see how taking 5 extra seconds can turn into real, tangible savings. Step 1. Avoid peak hours. Look, if the highway is jammed, just wait. Sending transactions when the network isn't crowded avoids that massive rush hour premium. Step 2. Compare networks. If you and your receiver can both support another, cheaper blockchain like BNB Smart Chain or Tron, just check the fees before you blindly send it on Ethereum. And step 3, always check your wallet's estimated fee before pressing confirm. Just taking a few seconds to read the prompt and follow these 3 simple rules can literally save you several dollars every single time you transact.
To bring it all together, let's quickly summarize our key takeaways. Rather than just being this annoying nuisance, gas is actually the vital price you pay for using a blockchain. It serves the crucial purpose of rewarding the folks securing the network while completely stopping malicious spam in its tracks. Those prices are going to fluctuate constantly, driven entirely by supply and demand during busy or quiet periods. And most importantly, your chosen network completely dictates your final cost, regardless of how much money you're actually sending. Understanding these behind-the-scenes mechanics totally demystifies the whole process. It empowers you to make smarter decisions and avoid totally unnecessary costs. That wraps up our deep dive into the sometimes crazy world of transaction costs. But before we go, I want to leave you with a final, slightly provocative question to think about. What is the highest gas fee you've ever paid? I mean, we've all got a horror story of an outrageous fee from a crazy bull market or a super crowded NFT drop. Reflect on those past transactions, apply what you've learned today, and you'll be navigating the blockchain highway like an absolute pro from here on out. Thanks so much for learning with me, and I'll see you in the next explainer.